Buenos dias. Good morning, everyone. Thank you for your time. Thank you, Fiab, and thank you, Bolsa de Comercio de Santiago, for such a great event. I'm here with good people from the marketplace: Christian Zimmer, Anderson Alvarenga, Sebastián Torrealba. My name is Marcio Castro. I'm CTO of PMNF Vespa. And I will leave my colleagues to introduce themselves, and then we can start the panel. Thank you.
Good morning. My name is Christian Zimmer from Itaú Unibanco Asset Management. Our asset management group mainly focused in Brazil right now. We're expanding operation to Chile and other Latin American as well as US operations. We right now manage more or less something like 150 billion US dollars. And in my group, I work on quantitative strategies and on support for the asset management group for electronic trading approaches, systems, and general support for quantitative ideas when it comes to portfolio management.
Hi, good morning. It's a pleasure to be here. My name is Anderson Alvarenga. I'm head of electronic trading in Brazil. We support global clients. Basically, Itaú BBA Brokerage is a top leader in Brazil, and basically in the equities, markets, and futures and derivatives. For electronic trading, we support different business lines: high frequency, clearing services, pre and post trading, and traditional DMA using algorithms proprietary developed by us.
I'm Sebastián Torrealba. I'm the CEO of Algometrics Hedge Fund. We are a high-frequency trading hedge fund based in Santiago. We currently trade some major liquid markets on the U.S. I think we are the first and maybe the unique high-frequency trading fund based in Chile, and we are planning to moving on to Latin America.
Very good. So I think we should start then with you, Sebastián, and we'd like to hear your thoughts. And you start saying and classifying yourself as a HFT, high frequency trader. So how do you see the difference? How do you operate differently in Chile and overseas? And what major differences?
Well, the first thing here is to define what is high frequency trading. You know, there are kind of different approach to this one. The first one is that we're doing computer-based analysis of the markets. So we take decisions on the markets based on some stochastical models, heuristics, and different things. And we execute in the market using technology so quite fast. So there are kind of questions here about modeling of financial markets and the technology besides that financial market. So the first thing is, what is a high-frequency trader? It's a trader that needs to interact with the market really fast. If you analyze the market with this kind of quantitative analysis, you're going to see there are some patterns that are on the really short-term frequency. So if you look at the market that analyze that in terms of seconds or milliseconds or microseconds, you're going to see that there is microstructure in the markets, which is kind of different from different market, from different kind of facets. There are some kind of properties that are stable there. So from point of view of the modeling, that's why we are into trading really fast. You know, so in the part of the execution, who is the other branch there, you're going to have three main items there. I mean, if you have a model who is running really fast and you need to be trading on that kind of speed, and you're not able to execute that because of your technology and whatever it takes, the model won't fit to your overall strategy. So that's why high-frequency trading is important there. There are a lot of other issues there on the high-frequency side, you know, especially from Latin America. I think that we are in a really good point right now here. We've got Peru, Colombia, and Chile. If you add all the market cap of these three markets, you're going to have something like second Brazil from Latin America. So in terms of exchange, and these countries is really a good business right now in order to integrate the exchange with the MILA. There's so many things about high-frequency trader. I mean, it's just not to have a model, you know, and go and start sending orders, you know. There's so many things about risk management, the technology, you know, dark fibers, low speed connectivity problems that are right now in Latin America. I know there are some guys that are starting to do algorithmic trading here in Santiago, probably from abroad, not from here. They are testing the platform, and probably the liquidity right now is not something that we can use for high frequency trading. I mean, we probably trade, I don't know, between 200 to 300 millions US dollars, a month, and just one strategy. And here in Santiago, it's kind of 2 or 3 times that trades a day, so it's quite too much. In terms of another business that is going to arrive here into Santiago is the electronic market maker of Forex. Right now, if we want to do some cross trade between Colombia, Chile, and Peru, we don't have something like an electronic market maker who has the speed to do the hedging of the currencies from different sides. So it's mainly what we.
Very, very good, Sebastian. Just want to reinforce that the audience can send the questions to this group here, through the Twitter, and after, at some time, we also leave the audience to ask questions through the microphone. It says, exactly interesting the discussion around how to identify, how to classify yourself as a high-frequency trading. At the VMNF Bovespa, we apply a particular discount for high-frequency traders because cost is really important for high-frequency trading activity, and the exchange wants to grab that new class of market participant. So we classify then a particular client as a high-frequency trader, which from the regulatory perspective is really good. Things are being discussed nowadays in relation to that. So, and to your point also, Sebastian, it's really important to have a basal liquidity before you get into have conditions for high-frequency trading to work. Now, Chris, how do you track if your strategy is making money or not making money? What's your experience in monitoring your strategy and how you're capturing alpha for how long? So can you show your experience around that?
Well, in our system, we base every trade on, we divided first the strategy. So finally we see what every strategy does. The approach in our group is quantitative approach. So it's a way that we, I think it doesn't work, right? Is it good?
It's working.
Okay. And no, it's something like, it's very based on a lot of statistical approaches. So we mainly do some kind of Bayesian statistics, updates on the results that come in from every strategy, check in if how much the distributions deviate from what we expected from our back tests. And in that manner, we track the strategies. But it's what makes me think on how to answer it best is when you come to talk to alpha. And alpha is a very vague concept, right? It's something like you can throw it together with definitions for high frequency, for quant, whatever. That is something hard to define. You can find a definition if you make this typical regression approach and say everything that is not white noise, that is not linked to a risk factor that you identified is alpha. But we don't use this kind of way to identify the result of strategy by strategy. Right? We have strategies, well, at least, finally, when you say well, alpha comes from, or you go there and don't put one kind of a risk factor on the model, or you make time, when you have time, alpha comes from other time frames. So that's not the way how we say, I look strategy by strategy for alpha. I look strategy by strategy for excessive return against my benchmark as it's hedge fund what we manage. So we track it all against CDI overnight rate in Brazil. And we could do this with a beta of 2, 3, 4, 5, whatever. As it's so variable and so fast, you can't really identify this as beta or alpha.
Christian, so apparently it's bringing good benefits for you as a high-frequency trader. What are the other benefits for the markets high-frequency trading brings?
I wouldn't necessarily say that high frequency trading gives good benefits for us. It's one of the strategies. So if you, the most important stuff is wherever you trade is you have diversification. So either you diversify in assets, you have to diversify in strategies. Not all the time all the strategies work very fine. And we don't base our funds on only pure intraday trading. So we have long-term strategies. If you trade one of the biggest markets in Brazil, that is the fixed income futures curve, that's not really for trading high frequency. And you take positions for 3, 4, 5 days and have a good curve model. You can make good money with that. You try to trade the dollar future in Brazil and high frequency. It's not really high frequency. At least not if you go in and all the time want to spur in $500 million of reais to run the market in each of the direction. The structure is so big that you won't really make high frequency trading. It really takes a good time for the market to move so that you can capitalize on your position. The only really what you would say, what comes closest to what in general you would understand as high frequency is when you trade the Ibovespa future against the mini future. Or you can trade the ETF against stocks, this kind of stuff. But that's a limited market. It's not like in the US, so that wouldn't make you survive on your own.
Christian, in the prior presentation, Spencer Green mentioned or questioned if the high-frequency traders are going to be the new market makers.
Mm.
What is the high-frequency trading bringing benefits to the market in reducing spreads, or what are the benefits in general that the markets are getting with the high-frequency trading activity?
It's a very, I would say, it's a very polemic question. It's something like, is liquidity good or bad? Well, I would say it's not bad. Is high-frequency trading good or bad? It's something like, you can't even define it. So I don't even like to talk about high frequencies. Mathematician, if you can't define it, I don't know what this stuff is. I don't know what is a quant fund. I don't know what is high frequency trading. I think that's, it sounds sexy. It helps us nerds to look nice on the picture, but it doesn't help you on the discussion. If you say, well, I want to trade a lot and I get liquidity in, it depends on what you run as a strategy. So market making as a strategy is a strategy that makes sense, that can make you money. If you have big spreads in the market, let everyone get you on the spread, you get money. If the exchange goes there and says, oh, I give you a rebate, even better, fine, it's a good strategy. If you go there and you see there's pure arbitrage, could it be for milliseconds, could it be for hours, whatever, you trade that one. You won't be a market maker. You get liquidity, you get the positions done. That is always good for the market. I can't see how liquidity is bad. If you go back to what Spencer mentioned, and I would say, well, it's hard for me to see another argument, but if you say in a moment that you have a lot of machines running and they can react fast, well, if you slow down the market, if you go to auction, that can be even worse. It's like, I don't know, who knows Sao Paulo? If you're in Sao Paulo, you see a very funny event there that is Friday afternoon. Everyone wants to go to the beach. The beach is only 45 minutes, and you have highway that is very fine highway. And okay, they say you can't go too fast because it's a dangerous highway, and they don't want the people to shortcut it through the forest. But if you say that, okay, there are so many Bolivian people going down there, and you say, no, this 4-road highway goes down to 1 road because I don't want everyone to go fast there. Would it make sense for you? So you need 2 days to go down to the beach, and then you come back. Well, would you say, no, let's take 8 roads down there, and you can come back faster. That would be the normal way how you proceed in these cases. And I think that's important. The market is capitalism in pure form, and it has a good point. So if you want to put socialism into the market, I don't think that would help. That only gets it complicated. So make it fast to go down and make it fast to go up. You're back where you were. That could be the best solution, perhaps.
Very good. Now, Anderson, onto you. We saw the benefits that can bring to a buy-side participant trading on a strategy that is based on high-frequency trading. We can see the benefits of high-frequency trading for the markets. Now, starting to discuss about the downside on high-frequency trading. So, to start with, have you lost money or clients because of high-frequency trading activity? So how do you see the overall downside of high-frequency trading activity, if any, in your opinion?
First, for high-frequency trading in Brazil, that's we have more experience with that. I guess that's we don't have a downside at the moment, and soon that you're looking for risk management with a very secure condition. I guess for high frequency, when we are working with this kind of client, we have to, for the brokerage view, we have to understand how money this client can bring to you and how money you have to invest to prepare an environment to him. It's a very tiny revenue, so you have to understand how profitable will be that tools and softwares and hardware and space that you have prepared for that client. For a brokerage view, if you handle these conditions with how profitable and how many technology that you have to provide that client, will be, I guess that you not lose money with this client. Okay, for the perspective, the market perspective, I don't guess that we have. It's a bad scenario using high frequency in Brazil. As soon as the regulatory improved by BMF and Bovespa in Brazilian market, like an auction, like many other restriction and rules that the markets are offering today, that restrict any kind of lose, I guess.
Very good. So you're to the point where the regulation, some level of regulation should be applied to the high frequency trading activity. So you mentioned a couple of them. Do you see any other space or room for improvement in terms of regulating or self-regulating the high frequency activity in general?
Yeah, you know that we have a huge issue with Zé com Zé. That's you feel better than anyone here to explain what is Zé com Zé.
It's Joe with Joe, or it's a self-trading. I mean, when you trade against your own account.
I understand the rule Zé com Zé when it was made in Brazil to protect, manage the markets. When you have a big player can manage some stocks, some contract. But when you are using high frequency, is basically because of latency, because of congestion of the market and volatility, you can make, and they are making a lot of Zé com Zés in Brazil. This is a big issue for post-trading scenario. We know, we understand, we are suffering with that, with many other brokers in Brazil. When you have a client of high frequency, we have to manage all this Zé com Zé, that's when you have two sides of the same tax number ID, the same client, and you have to change for another client in post-trading, in intraday. So a condition is for high frequency is a condition to not extract the Zé com Zé in the market, but think about it again. Think again about how we can work with a Zé com Zé in specific stocks. Maybe the liquidity stocks we don't need more. It's just in a non-liquidity. Basically, Zé com Zé if you can make this for us, we will solve many issues to us.
No, I have
Please
to,
bring it.
I have to say something. Well, the first time you can know that, please, I'm on the side of the exchange right now, you know? I would say, well, no.
What a change.
I changed my mind, you see. I would say you should not put this on. You should leave this in the market. This self-trading should not be allowed. Because you said high frequency in a general, when it creates liquidity, is good for the market. If you abuse in the market, then any kind of trading is bad for the market. It can be high, low, whatever frequency. And I think self-trading is something that abuses in the market, that can abuse in the market. And the point is, it's bad for you because you pay the price, but there's someone behind that. And that someone behind that didn't make the job fine. If you look in our account, you won't see that we do that. We did it occasionally because we crossed strategies with different approaches. But we saw that happening, and then we put some kind of a firewall to avoid this happening. So if it comes down that you have a strategy, whatever, that you think that worked fine in Singapore, and you go to Brazil, let's apply it there, I don't know what's going on there, and you try to trade, and you self-trade yourself, well, you get hurt, and you should learn how the market works. And at the moment, the point is the downside. When you allow that you can self-trade, I manipulate the market directly. So you get trades over there, you go in big volume in one direction to make the market go in one direction, to give idea that the market goes in one direction, and you close your position again. That is very bad for the market. So it should be avoided that this happens, and there should be a good fee on that. Then you can avoid this kind of discussions, high frequency trading, good or bad. Because you really will see that bad things won't happen in this case. So you, as a buy side, you must do your homework. You must calibrate your strategy. If you think you want to make an arbitrage and you got problem with your second leg in the position, and you think, I put everything in the market and see which position I hit, and then, I forgot I got another position there, and I hit myself and go out of the market. That's wrong. That's not, you didn't do your job fine. So you should be punished for that. I think that's not right to put it down.
I would like to add something to that. A couple of months ago, the NICE was asked by the SEC about the large trader ID identification. So right now, every guy who is trading in the US who's doing more than $20 million a day, or 2 million shares a day, or 200 million a month, must apply to SEC in order to get a large trader ID. So SEC is quite preoccupied about looking what are the guys that are doing things like that. Right now, they don't have the ability to know and see who is doing, self-trading. So I think that right now we need to get a play field where all the lines are really clear in order to how we can do our strategies. And I absolutely agree with Christian about that. If you are doing self-trading, you're doing something wrong. You need to calibrate the strategies, and probably the regulator should step in and take a sanction or something like that. That's the way that should be regulated.
Oh, very good. Definitely, I think that the topic, like in another opportunity, Christian said that the high-frequency trading is like Brad Pitt. The men hate him, and the women love him. So it's kind of that. So definitely, there are good and bad things, depending on the perspective that you see. And we, on the experience, and also from the video that Andres showed us, the May 6th flash crash was a perfect example. I'm sure that we will no longer have that similar type of crash, just because people understand where the mistakes were, they make appropriate changes, and that goes along creating some kind of regulation around high-frequency trading. So Anderson mentioned some of the things that we have at the BMNF Bovespa, which by coincidence we have a recognition of a high-frequency trading. I think that's a good start. So you know where to look, which is different in other places. I think that's a good start. We have that because of two reasons. We have the end beneficiary owner model, and we also have the discount that we apply. So you need to know who is the high frequency trader, otherwise they don't have the conditions to apply the discount. So all of these bring a new facet to the regulation. Well, there is also limits that are applied to high-frequency trading. We have basically something that we charge in excess of codes that are provided to the market. I think that prevents somehow code stuffing and spoofing in a way. There is also a throttling mechanism to prevent the market, to preserve the infrastructure for the market. So a couple of things that we were working, and recently there were NASDAQ coming up, NASDAQ PLX, with a new order type that brought a lot of new discussions around regulation on high-frequency trading, which is an order that will last for 1 second or will last for some time. So people start to think about, should an order last to at least 1 second, respectively of the type of market participant? So those type of discussions, I think, are very, very interesting. But on the other side, there is also the discussions around how to regulate technology is very hard, because there will be always an innovative way to work around to have another way out. So I think it's perhaps the discussions we should also take is, what are the market participants that are going out of the market because of high frequency trading? So I'd love to hear the panelists here. Are there any market participants that, because of the high frequency activity, are leaving the market, or are all of them benefiting from the same order book and having different market participants having different roles, a hedger, a retail investors, a professional trader? Are they all benefiting from this order book?
I think the markets are here in order to trade, you know. That's kind of the main function of the market. So if you look at all the participants of the market that you mentioned, you know, a guy who is doing a hedging of an option or the future or the volatility trading, you know, they need to have a liquid market. They need to trade right away, right now. So going back to one of the things that you told about, you know, putting some time frame or time window that the order needs to be there. First of all, it cannot be handling easily by the technology side, you know. So how do you measure a second? Is the second not exchange? In the second have the venue? Is the second where you send it? So, okay, and then how we define a second? Okay, it's going to be a second defined in nanoseconds or microseconds until a second. Okay, so you're going to have guys there so fast, they're going to be on the limit border, they're doing the same things ever. So that's one of the things that you cannot kind of try to put. I understand also that some exchanges are trying to put in a fee every time when you put a quote outside the market, in order, you know, to not to be throwing inside the market, you know, 1 billion quotes for 2,000 instruments at the same time. That kind of thing kind of avoid, you know, the quote, the stuffing thing, you know, the guys are trying to slow down the exchanges itself. But I think that we need to going back a little bit in terms of thinking about why do we get this in the US, this market that we trade, why we get this so fragmented liquidity right now. So we get the NYSE 20 years ago, it was the most important market. And then this kind of new cost structure of exchange that BATS came through, and also NASDAQ, about the fees and rebates when you add or you remove liquidity in the markets. So that kind of cost structure absolutely changed the liquidity. And right now the liquidity is bumping every exchange. So if you take a look at a high frequency trading strategy, or you look at to deploy an algorithm, you look at every time the liquidity, you need to scan about liquidity. So it's NASDAQ, it's in BATS, it's in New York, and this is a thing that needs to be faster and faster all the time. So right now, regarding the question, you know, about they are good or bad for the market, the high frequency trading, I think that everything that adds liquidity to the market and can produce that the market can trade on every price level and every time, is going to be really good for the markets. I mean, from your quantitative strategies on your fund, you know, you're going to have a price every time, and you're going to can pull a big volume to the market without bumping too much the bid and ask. In terms of the hedger, you're going to have a fine tuning from the volatility calculation of the option. So there, from the retail exchange, you're probably going to have tiger spreads on every symbol. So the kind of good things there. And in terms of the volatility, that probably people tend to think that high frequency traders do increase a lot of volatility. I can argue that quantitative models, you know, that trade not so frequently and take big position over the trend can produce more volatility than even high frequency traders. So I think that probably people tend to think about this issue as they don't know how high frequency trading works, or what is beside that. This is a kind of technology framework. So it's quite difficult to argue, and you can see that on the SEC report about flash trading. You know, so at the end, there was no opinion about saying that high frequency trading were the guilty guys there, you know. So kind of a mixture of different things, and synchronization problems right now the most important issue about all the exchanges. We get something like 100 and 120 exchange events every day. We trade in 17 exchange on the US, so the handling of the communication, you know, you got different layers of complexity there. You got the network complexity. This is one point really important. You know, you need to measure, you know, latency on different dark fibers. You need to look at how the exchange is reacting, how fast. if it's change mode to slow mode, like in IC, you get blind for 5 seconds and until the practitioner there, move again to fast mode. And so you need to look at so many things at the same time. So I think that the synchronization problem is kind of the issue that can bring another flat scratch. And I think that another flat scratch can happen. I mean, there's no global coordination on the US. The circuit breaker procedures about the SEC are, I think that they're not well established and well defined yet.
Interesting. To this point, do you believe, because in the US you have over 50% of the volume coming from high frequency trading activity, do you believe, and the others in the panel believe, that Latin America countries will get there, or it will get to the same level, or is more going to be lesser than 50%?
No, but I think that absolutely we are going that way. It's a matter of time that the local exchange in each country in Latin America tends to have the system that can support this kind of trading. And it's kind of a difficult decision. So we're going to have a really good increase in volumes and on every exchange, but that's going to be when high frequency trading arrives. But if you don't have the infrastructure and the liquidity to high frequency arrives here, it's not going to happen. So it's kind of balance between those two things.
It's not all just further, it's not only technology. I guess like in Brazil, when you have IOF tax with a 6% over the clients, that's once who comes to Brazil, make this kind of trading, and that's a certain little bit difficult to give leverage to clients in Brazil as well. So I understand we remember when before the tax, IOF tax in Brazil, we had a lot of clients in Brazil coming, discussing about that, and after when we got the tax, IOF tax in Brazil, we had many issues that avoid these clients coming there. It's a big issue as well. That's I understand is protect the country, but and the high frequency for financial markets is a huge issue that's avoiding clients to come to Brazil.
Very good.
I don't agree with that as
well.
First of all, because once again, definition is bad. If you look at your report every month coming out, number of high frequency trading, the percentage of high frequency trading at BM&F, make it easy. Stop trading and the DI future for one day, and the percentage of high frequency trading will go from whatever, 5, 6, 7 up to 15, 20, whatever. It's just the way that you calculate that stuff. And but besides of that, let's assume we start from the 6 something, what we can see the percent. You want me to say that we come to 50%. Let's go back and see what is high frequency trading, what you want to see as high frequency trading. Let's go to the strategy. Rebate trading you won't have in Brazil. You can have it with the other exchanges, perhaps in Latin America. I still pay for the governments to make the stuff working fine without its taxes and all that stuff. There's different currencies and so on. So in Brazil, only in Brazil, tell me how you want to do it. Rebate trading you won't have, right? So the biggest part of where you make high frequency trading in that way that you would understand it, it won't happen. You can do it as market making, right? A good market making strategy. Okay, let's go there. You have, let's get it in 50 stocks, 60 stocks that would be interesting for doing that. And perhaps you won't even do it in the 10, 15 most liquid ones because the spread is 1 cent. If you're not a designated market maker where you won't pay the exchange fees, it's so expensive for you to doing market making in a spread that is less than 2 cents, Brazilian cents. It won't make sense to make a market making strategy, too expensive. So you must be a market maker. So if you're a market maker, the exchange goes, well, I don't need a market maker for Petrobras, for Vale, for E2. You will be a market maker for whatever, Lojas Renas, something like that. And yeah, okay, then you get 10, 15 stocks where you make market making. Come on, where you make money? You make money a bit, but it won't make 70% of the overall volume at the exchange.
What makes you rich?
Someone may get some money on that. And these both are the most important strategies, right? Probably you have to ask all the brokers what they see as strategies, but I will bet that these are the most important ones. And then you go, what comes next? Arbitrage trades. But when you make arbitrage in Brazil, you can make it with fungible assets, so futures for the mini or for the big one. You can try to make ETF against some stocks. But which ETF is interesting for trading is the Bovespa, BOVA 11 ETF. Now go there to BlackRock and say you want to rent them. You get the fee for them to, I need to short sell that stuff. They make big money in renting that ETF, so that's a very expensive trade too. And you go there and destroy the ETF for buying too many stocks. That's very expensive. You need a lot of money. You won't trade on that with less than 20 million for putting in there. That's not every boutique that goes and trades that.
Very good.
So there must be a strategy that could support for you to increase from 5, 6, 7% to 70%. And I can't see that. Or if someone tells me, I will be happy to hire them and tell them we make money on that, but I can't see it right now.
Interesting.
Sorry for that, eh?
No.
I think that you need more price resolution on your exchange, you know?
Yeah.
That's kind of one thing that you can
Oh,
do
don't tell it to me.
Oh, your country.
No, interesting. Yeah, I think that's definitely transaction cost analysis is really important for you to make sure. And I think it's one thing that gets US with that amount of high-frequency trading is arbitrage between the 50 marketplace around there.
And that comes together with what you can do with different assets, futures against ETFs, ETFs against baskets,
Yes.
options where you hedge options with stocks, and so on.
Exactly.
These kind of strategies are originally for you make it automated. I won't say high frequency. You can get one arbitrage trade every 2 months, perhaps, because the opportunity won't appear all the time. That's not high frequency. It's very, very low frequency. It's low latency. But in this moment, you can trade it. But you have to have this opportunity. Which option can you trade really liquid in Brazil? You get a handful, right? Otherwise, you should be a designated option market maker for doing that. Otherwise, that's too expensive. So for the market for itself doing that in Brazil, not easy. But if you tell, well, get another exchange, lower the fees, get another clearing entity and so whatever, and then it comes that you get these problems that you...
Yeah, the discussion market aggregation versus disaggregation.
Then it comes to other problems. In a market that is not so liquid, if you try to divide the liquidity can be even worse.
Sure.
So let's be happy with 10, 15%. It's good. It's a deal.
Very good. Now, getting back to the good and bad on the high-frequency trading, from the technology perspective, and I can say by myself, from one day to the other, I already saw volumes of messages going up 50% one day, 100% another day in the same week. So in some occasions you don't have servers to add from one day to the other. You don't have time to increase bandwidth. So it's very intense in technology. From one side, it's very good, because then for technologists, as I am, it's very important, very good, because then I can develop my experience to the maximum. From the other side, I believe that there are a couple of market participants that suffer a lot, especially in days where the economics are not that good as this year. So I see that market participants, such as some broker-dealers, are suffering to keep up with the technology. So this is one aspect that is very intense. It's good from one side, because then you apply the best of the technology. It's bad from the other side, because you can wipe out some market participants that are important in some way. The exchange has a preoccupation around that to avoid concentration and to keep up, to create conditions for those participants to have a way to keep working. So a couple of examples of things that exchange are doing. One thing is to create channels for market data distribution in a conflation mode. So not all the participants need to have 1,000 of prices updates per second in an instrument. So they may be happy with 4 updates per second, because they are doing point-and-click trading using screen. So that's one thing. Other thing the exchange is doing is also motivating the broker-dealers to distribute algorithms to their clients. So a professional trader, what we used to call a high-frequency human trader, someone that trades very fast but uses the screen, they can keep up with that, because the complaint right now is I can't win. because the machine always gets first. So if you, as a broker-dealer, start to distribute algorithms to your clients, especially for those, let's say, high-frequency human traders, there's a way for them to keep up and still work in this market. And things also the exchange is promoting, which is exchange, for the market participants to start sharing services among the others. So I believe that we'll have panels and discussions in this conference around cloud computing. So that's something that exchange is also promoting in order to create conditions to market participants to keep up. But from the good side, it's always good because you always learn and know how to do things better and to increase performance and reduce latency and standard deviation, so on and so forth. So for the panelists, what do you have that we can take home of things that you are creating or developing around technology that you think that would be benefit for the audience?
I think that first, order types, Right now, every exchange has something like 10, 11, 17, 25 kind of orders that you can put there. iOS, immediate cancel, they're kind of different orders. And you get, then there's another layer, and you get something like orders from brokers. They're kind of more sophisticated. You can put a VWAP order, you can put a TWAP order. So a pension fund, for instance, pension fund who is a guy who is not doing market timing because they're too big, sometimes they can put a VWAP strategy going to the market, and sometimes they can put something like 4 VWAP strategy, 2 short and 2 longs on the same instrument, on the same basket. So that kind of thing also produces the volume increase quite a lot. That's one point of view. So there's going to be a market there for broker-dealers, and also I think that broker-dealers that step up and be the first in order to provide to their clients, this kind of good algos, and evolve constantly about how they produce the thing. And for the other point of view, you told us that for broker-dealers, it was kind of a really heavy load in order to be, with all of this technology, changing constantly. I think that absolutely the solution for that is cloud computing. So there's another bridge between, modeling and high-frequency trading and computing. It's going to be the IT business that's going to be born here, because we got a lot of brokers there, mainly all are doing the same. And right away in Latin America, I think that mostly of the current IT development are carried out by the exchange itself, not by the broker. And that's one thing that probably is going to change.
Are you a current user of that type of technology for your trading
No,
activities?
we currently use our own strategies because for high-frequency trading it's really fast, so you need to be really sure about what are you doing. It's kind of a lot of detail for every order. But I know that, and I got my brokers in the U.S. that tell me, okay, I got this new order. You get orders from the open market, from imbalance, from closing market. Orders, for different kind of things that I'm constantly receiving about them.
When we have some clients, there's no so sensitive latency. This kind of clients in Brazil using algorithms for execution. In that case, like we had experience to develop our own algorithms basically 2 years ago, and we are going to the market basically the last months to offer. And it's not only the pension funds, the long-only view that they're using, like a VWAP, TWAP, or trading, or any other synthetic orders like always IOC or MOCI, FOCI, any other kind of synthetic orders. But the quanti funds that's no so sensitive latency they're using as well. Okay, well, because sometimes they are wants to distribute the orders during the time. Once they use kind of triggers, they're using some snipers. So in Brazil, some quants and directional strategies are using these algorithms for execution. Respect for, I have additional points to say to you. The collocation was a very, very good point to equilibrate the Brazilian market with the broker-dealers. You know that Itaú BBA had a decision to make their own data center because we are a bank. Maybe we have some flexibility with that, and other banks as well. But for independent broker-dealers, that's using today collocation at BMF Bovespa. That you created an alternative for them. Like sometimes you don't, you can use a straight connection, not naked access, but can use the risk limit, risk management provided by BMF Bovespa as well. And so there you have a space shared for the whole broker deal as well.
Exactly, it makes available for all the market participants.
Yeah, cloud computing at the collocation side, eh?
Sure, it's a type of. Yeah,
yeah, could be fine. Cloud computing is something we don't use too much. The structure, how we build it up, is something like that. And we in the internal environment is something like the overall. The system has independent agents that in a multicast environment communicate to each other. If you have something that is really low latency dependent, it should be in collocation. If it's something that is not so dependent on the latency, we can run it on these agents. These agents mainly communicate via sockets or if shared memories if necessary for something that has to be done faster. We run something like 25 independent servers for making additional calculations, right? So in parallel part and put it back. And what we're looking for is something like we're testing some kind of hardware acceleration to making to speed up the communication part, right? So if you all run it via UDP, it takes a special part of time, and we don't want special communication leaving it too much in software environment.
What type of hardware acceleration are you considering? Is the FPGA?
Yeah, we are mainly focusing right now for FPGA. We want perhaps next year look for a GPU for making our parallel computing faster because it's running on some Windows servers. It's not so efficient, but it's some kind of stuff that is only for strategies that don't run so often. So it's not so severe. But in order to make it for strategies where you can run faster some calculation, I think GPU would be a good solution for that. But the first step is for FPGA. So especially market data, getting in the communication between the agents, like our risk engine, like our strategy engines, all that stuff. They have to very often pass information from one part to the other part with our post trading coming in. They have to reconciliate that one, and that should be fast.
Very good.
Let me include when you are talking about FPGA, really that has important point that we have been discussing internally. Sometimes FPGA is a way, but you have to look to the market and understand how latency that you have to improve for your clients. FPGA is an innovative solution in the world. It's not only in Brazil and Chile or is in the world. And when you have innovative solutions, a little bit more expensive than others. Okay, we can find other ways to provide like a high frequency gateway with API or fixed straight or any kind of software solutions to improve the latency instead to use the hardware. Okay. I agree with hardware. I guess that's the best one. But first, we need to make a profitable business, right? So you have always consider how many technologies that you have to provide, and you have to take revenues against your costs technology.
Yeah, very good.
Sorry, from the GPU point of view, that's just going to fit from the bar calculation for a big bank, that kind of thing, Monte Carlo analysis and all the stuff. But for real-time thing, I think that right now the technology is too complex to develop. You need to get programmers to program in CUDA or whatever it takes. So it's quite difficult to find them here in Latin America. So I think that for trading itself, it's going to be tough to get that. And from the FPGA point of view, I think that it's quite a hard bet in order to develop something like your own chip for a thing. We spend $10 million to do one thing, wait 2 years, and you have the uncertainty about it. It's going to fit in 2 more years where you sign it right now. So it's kind of a difficult question. I know some guys here in New York that run that kind of business, but it's kind of a difficult one for these two things.
Perhaps I'm ignorant too much on that, but honestly, FPGA card I can program at home, and that's not so complicated. And the question is how you do it with the chip. If you get one of this very specialized, very expensive, so okay. If you take a basic one, like buying the Porto Alegre land south of Brazil, this kind of stuff is not expensive. Okay, you burn it if you did it wrong, okay, whatever. But after some time, you know what you're doing. And in that moment, it's not only the acceleration that you get against software. It's a bit. You're fast, but how much you get your core down using for other stuff is important. If you get whatever the 16 cores on your machine and you need 4 or 5 or whatever in this range only for data processing, that's ridiculous. Okay, that's something where you lose efficiency. So if you put it on the hardware, you get more free space and you get money virtually. You get money back from freeing other resources that you can use for better stuff. And I think that's it. Probably you won't put a strategy on FPGA because strategies move much more faster.
Oh, very interesting. So the audience can see where we are heading up in terms of technology, of getting your algorithm inside the chip with FPGAs to get the latency down. So it's really a race to zero as of today, if nothing changes, if the regulation doesn't impose any limits to that. So it's really interesting where this is heading up.
Can I add something? I was in London a couple of weeks ago, and I was talking with some guys at the CME, and they told me that what they are been developing a kind of new technology in order to virtualize everything. You know, they want to, all the algo traders or everyone who want to trade algorithmic in exchange to peg your algorithm to the trading engine itself. So they're going to design something like a big infrastructure. They're going to virtualize everything. So every client is going to receive the same kind of processing amount, the same kind of latency, the same kind of memory bandwidth, and all the stuff that you need to do your trade. So, and that's kind of one proposal in order to solve this problem about the discrimination about, you know, big high-frequency traders and retail investors that cannot something like trade like that. So I think that there is a point there in cloud computing in all this algorithmic trading environment.
It's a form of socialism, huh? Everyone is equal. Okay.
Or fairness, if you like.
Fairness, yeah. Okay. Yeah, I think it's fair. I always say it's fair. The next time Argentina plays in the final against Brazil, and everyone says, Brazil is better, so just play with 2 people. 11 against 2, it's fair because Brazil is better in football, right? Why don't they do that?
Very interesting. Well, we are...
You don't have to do it against Germany, right?
That would be too unfair. Well, we are heading towards the end, so I reinforce that if anyone at this stage wants to make a question, but Spencer? 2 questions? Okay. So open up for 2 questions. Sure. Thank you, Andres.
Hello. Hey guys. So a couple of comments. One is on the CME virtualization. The interesting thing is when you go to cloud computing and you say we're going to virtualize the environment, so every customer gets the same SLA, because there's different customer categories. What you've done, or what the exchange has done, and I'm sure you can see where this question is going already, is you've created lowest common denominator. So you've generalized it so much that it's actually the slowest way because of how it's layered. It's the only way to do it to guarantee the same SLA to multiple customer segments. So if the CME does that, or when they do that, the next thing that's going to happen is some of their customers are going to say, you know what, this isn't fast enough. But we have a case at TIBCO where the guys from Goldie that were trading on one of NICE's matching engines had been trying to measure Bear's latency. And they actually went to Steve, the CTO of NICE, and said, based on our calculations, we estimate that Bear has shorter network cables than we do. Right, so at a certain level, I think when you go to the cloud thing, you're doing lowest common denominator. So that was one comment. Another comment was on the FPGA. FPGA is interesting, right? So we actually sell a hardware appliance that does messaging in FPGA. But there was a big shift towards FPGA. Recently, a lot of our customers, especially the hedgies, have been moving back away from it for a couple of reasons. And I'll tell you the quote that was given to me by one of the prop groups at one of our big banking customers, and that is, FPGAs can't compete against Intel's R&D budget. So when you look at programming an FPGA, okay, it's a gigahertz about, but they can go faster, right? You can overclock your Intel chip to 4.93 like some of the guys are doing. But it's not just that. It's not, I've got 4 cores, 5 of them are wasted. I can do that with one FPGA. Well, next year, the year after, you're going to have 512 cores, and they're going to be running at 4 gigahertz. We were talking to one exchange startup that wanted to do their matching engine as shared memory. Now think about that. That's a pretty radical step, right? They're going to have multiple cores on the machine, massively cored as we call it, their matching engine doing shared memory with the broker-dealers. And of course, one broker-dealer may bring everything down and trash the machine. But I mean, that's the sort of extent to which people are going. Anyway, just a comment.
Very interesting space. So we have space for more one question.
Well, thank you for the panel. I'm trying to see if I can make it into a question, or like Spencer, just like an exposition of what I could take from your discussion. Because in the end, what I'm seeing here on my side is latency is a really bad investment for us, right? I mean, Latin America, I think in general, all these exchanges, they need to get together or need to spend a lot of time to understand what really this means. Like Zimmer said that Flash will never be implemented in Brazil. There will not be rebates, you know, to liquidity providers. And at the same time, we're giving rebates to them, right, in the sense of lower exchange fees, right? So who's benefiting for the high frequency flow, right? Because the investment on a sell side is quite big. The investment to the exchange was very high. I mean, you remember what it was from 08 to now, how much the exchange has spent the money. And Sebastian is right. And then we have all these, you know, let's bring to the same level everybody that latency now is 1 millisecond to the market. Eventually, like Spencer also said, that someone will come with a new invention in which, you know, he's going to be routing your order 50 microseconds, and there we go again. So I'm still unsure what is the future of high frequency in Latin America, because there must be an inflection point to every participant. At one point, I will stop investing, right? Because it does not pay the bills. Because at the same time, the hedge fund will come to me saying, okay, you charge me, I don't know, half a penny per share or maybe even less. Right? And in the end, I mean, I cannot see the return on invested capital if there's no P&L. Like Zimmer said, how hard it is to achieve the P&L in the Brazilian market, for example, which is the largest in Latin America. So what's going to be the end game for all of us if we continue to spend a lot of money on equipping and hiring people from MIT and buying machines and trying to be the fastest in the market and not seeing the return on that investment?
Perhaps I can give some on that. The things, how they happen, they have some reason, right? The exchange, for example, they have a monopoly. If you go there and don't spend your money, everyone gets nervous and you. So they make it good. They use the money for investing in technology. Everyone becomes happy. If they want to save the money back home, and everyone will be getting that. So now you make too much money. That is not fair. That gives trouble to them. So it's a good idea for them to invest in technology for co-location, for the matching. Now, when it comes to the sell side, you probably have to think a lot what you do. Would it make sense for your sell side offering low latency environment for a Brazilian buy-side firm? I would say no. Would it make sense, like Anderson did, setting up a data center, a proximity hosting? I would say yes, because you can attend international clients. You can offer cross-market arbitrage futures against cash markets. That is something you won't get in co-location. So for this kind of clients, it's very important. For the smaller hedge funds, it's very important. You have to think, well, would I spend a lot of money every year for maintaining my servers, for having an IT group, or can I host my servers in this kind of environment? That's probably not a strategy for a smaller brokerage firm because it's so expensive. But for the big ones, you should offer this kind of service. Then you go to algorithms. Well, definitely no one needs a smart order routing in Brazil. But if you have big institutional clients, and these clients, they pay good fees. They don't pay half a penny, right? You know the accounts. It's good money. And if you go there and you can get these clients saying, well, I don't have a T-Web. That's commodity, this kind of strategy. You know, I have a very interesting strategy for you trading a big position in an indexed fund when you come to the end of the month and you get low tracking error. That's what we need. Where's the strategy? If you have this kind of knowledge, this kind of strategies, you get these clients. And these clients will stay because of the know-how that you have, because of the product that you have. So there's a strategy for sell-side in this space for automated trading. You just have to focus out what is the right way to doing that. And I think the business is there. It's not necessarily what you need as what you call high frequency trading, rebate trading, whatever. Don't waste your time on that. You go in co-location and whatever. That's not your investment.
Yeah, I basically agree, except for the part that exchange is a monopoly.
Okay.
You compete on a global basis. Well, I think the investment sometimes is not that big. I mean, even participating in an event like this, you get very good amount of information without investing too much, and then it starts to create your business plan, and then you start to be able to see if that's really going to make you make a profit and make money with your high-frequency trading strategy. I think that you always need to think about an order book where all the market participants can take advantage of that order book. So you not only create products or invest in technology for your high-frequency trading clients, but also you need to think about your retail clients. If you're a big institution, you need to think about the hedger, the institutional clients overall. So when we think the strategy in that way, then you can leverage better on the technology. And like I said, there is one upside for the technology is also we are going to be kept busy for long. So that's good for us. But for the market, that's also good. I mean, I saw in the last 3 years, I saw a lot of strategy that just died because another strategy came in that was faster. So there was time for that particular participant that saw his strategy no longer working to revamp his strategy. And sometimes it's just a small change in the application and tweak the application and get speed and you're back on game. Or it's just need to revamp the whole infrastructure. But again, if you want to serve your customers, and you need to think broadly and work out your business plan and do your transaction cost analysis. But in other words, I think it's the benefits for the market. For example, I always think that the high-frequency trading flow matches really well with the retail flow. So you have tighter spreads. So for the market, it's good. So but you need to take care of the downside of getting people out of the market because of the expenditure in technology, but also because of they are not getting faster or being able to reach the market prior to the high-frequency trading. So I think there are way out, but we need to work your business case really well and pay attention to the transaction cost analysis. So we're heading up towards the end. So I would like to thank you all the audience, and especially thank you for the panelists. Thank you.